Hello and welcome to the Weekly Outlook at XM.com. We have a busy week coming up with central bank meetings in Australia and Canada, followed by the Bank of Japan's decision and employment data out of the US. I'm Maria Pachordes, and joining me to discuss all this is senior investment analyst Marios Hadjikyriacos. So Marios, let's start over in Japan, where Bank of Japan officials will face a difficult decision on Friday. Can you tell us a bit about the state of the Japanese economy and inflation as it stands today, and also how the yen might be affected by the Bank of Japan's decision?
Certainly. Hello, Maria. It's going to be a difficult decision because there's a lot of conflicting signals around the Japanese economy lately, and specifically the inflation outlook. So we've seen inflation and wages fire up lately quite substantially. Both are running above 4%. And in fact, wages rose faster than inflation in January. That means real wages are finally positive, which is great news for the consumer. And of course, it's something the central bank has been waiting for a long time. Now, the catch is that most Bank of Japan members, including the future governor, they believe that this inflation wave is driven mostly by supply shocks, by energy prices, so it's not going to last. So to be specific, the government recently rolled out some subsidies on energy to support households, and those have driven electricity prices much lower, which eventually is going to translate into lower inflation. And indeed, we've already seen that. The latest inflation data we've gotten from Tokyo, the inflation rate fell very sharply. So there's question marks about inflation, but there are also question marks about wages because the spring wage negotiations between unions and businesses have just started. So long story short, yes, inflation and wages might be high today, but the Bank of Japan thinks that they might fall relatively soon. Now, that brings us to the policy decision. It's a close call, I think, because yes, the data today supports further tightening, but I also think that it's more prudent to wait because of this uncertainty around inflation and wages. Waiting until the next decision in April would give the officials more clarity on how the economy looks, and we will also have a new governor by then. So I think that the most likely outcome is they do nothing next week. If that's the case, that's bad news for the yen. But I also think it's not a game changer for the trend because they might not do anything next week, but it's only a matter of time until they do. It might not be next week. It might be next month. So I don't think it's any real game changer for the yen's trend.
Right. Turning to the US now, where the economy has been quite resilient, we'll get non-farm payrolls data on Friday. What are we expecting to see there, and how might the numbers impact the dollar?
Sure. So the underlying theme in the US lately has been just how strong the economy is. We've gotten a lot of data lately, consumer demand, inflation, the jobs market, everything remains quite strong despite these rapid-fire rate increases by the Fed. And the markets have reacted to that by pricing in a higher for longer scenario for interest rates. So the market now thinks that interest rates are going to go up to 5.4, 5.5% and stay there for a longer period of time. So that brings us to the upcoming employment report. The markets think it's going to be another solid report, non-farm payrolls at 200,000, that's the forecast. That follows 517,000 last month, which was a spectacular month for the jobs market. Now, as for any risks, most early indicators on the jobs market point to another strong non-farm payrolls report. The business surveys from S&P Global revealed an acceleration in hiring. Applications for unemployment benefits remained very low, so those are positive signs. But I still think there's a risk of disappointment in non-farm payrolls, and the logic is the following. Usually, when you get a very, very strong non-farm payrolls report like last month, it is often followed by a weaker number. We see a correction back to the trend, essentially. And since warm weather was a big factor in boosting the previous number, I think it wouldn't be surprising to see some payback this time. Now, the other main event next week is going to be a couple of testimonies by the Fed Chairman Powell, who's going to appear before Congress on Tuesday and Wednesday. Now, the markets usually react more to his first testimony, and I think that the risk there is that he strikes a more hawkish tone, following, of course, considering just how strong the data polls has been lately.
And finally, regarding the upcoming central bank decisions in Canada and Australia, what should we be watching out for there?
Yeah, so in Canada, the markets think that the central bank is going to remain on hold, not do anything, and that's because the economy looks to be slowing down, inflationary pressures look to be cooling off. So the markets think that the Bank of Canada is going to take the sidelines, take a back seat, and that means that the primary drivers of the Canadian dollar moving forward might be the performance of oil prices and the performance of stock markets, since the Canadian dollar has a very strong correlation with both. Now, in Australia, the market is pricing in a 75% probability for a rate increase. That's warranted by the data, which are quite strong. And since it's not fully priced in yet, a decision to raise interest rates could briefly boost the Australian dollar. Now, having said that, the overall trajectory for the Australian dollar is going to depend mostly on any signals about the terminal rate and what happens in China.
Marios, thanks so much. And thanks for joining us at XM.com for this weekly outlook.